Welcome to the deep dive. We're kicking things off today with something that honestly reads like a perfect financial mystery thriller.
Right, but this isn't fiction, is it? This actually happened.
Not fiction at all. And the main character isn't some, hedge fund manager in a suit. It's just an anonymous digital address.
That's right.
This entity pulls off one single trade, timed incredibly well, and nets a huge amount, $192 million, almost instantly.
And sends the entire crypto market spiraling into a pretty dramatic crash.
Yeah, exactly. This isn't some old story either. This happened just last week. And the same entity, this whale, they're still placing massive leveraged bets right now.
It's quite something.
So our mission today is to take all the source material we've gathered and really unpack this whole complex saga. We need to try and explain, in simple terms, who this powerful player might be, what they actually did, what mechanism they used.
And maybe most importantly, what this whole event tells us about the intense dynamics and, frankly, the pretty high risks you find in these unregulated crypto derivatives markets.
Definitely.
And before we dive into the play-by-play, we absolutely have to set the stage for you, the listener. There are three key terms you really need to grasp to understand the scale of this.
Okay, let's hear them.
First, a whale trader. Sounds dramatic, but it's basically just an entity. Could be one person, could be a fund that controls enormous amounts of capital.
Enough to actually move the market with just one order.
Precisely, enough to make waves. Second, we're talking specifically about the derivatives market here. This is different from the spot market where you'd say buy actual Bitcoin.
Right, spot is owning the thing itself.
Exactly, the derivatives market. That's where traders place bets, often with leverage, on future prices. It's fundamentally more volatile because you're not trading assets directly, you're trading contracts. These contracts magnify both the potential gains and, crucially, the risk.
Okay, got it. And the third?
The specific instrument involved here is the perpetual contract, or perp. Now, unlike a normal futures contract that has an expiry date.
Like it ends next month or something?
Right. A perpetual contract never expires. You can hold it indefinitely. And this feature is, well, it's kind of key to the whole Wild West reputation of crypto trading. It lets traders keep extremely high leverage open for long periods if they can manage their collateral.
Okay, that makes sense. So let's track the money. The entity, we only know it by its crypto address.
Yeah.
0IB317.
Just a string of characters.
And this whale was operating on Hyperliquid. That's a decentralized derivatives exchange, right? Not like Binance or Coinbase.
Correct. Decentralized. Peer-to-peer, essentially.
Okay. Now, the initial profit. This is what raised every single alarm bell. This entity, 0IB317, opened a huge short position. So a massive bet the prices would drop.
The very bearish bet.
And they did it just 30 minutes before the announcement came out that Trump would be imposing new tariffs on Friday.
Wow.
The market, of course, reacted to this big global political news, a risk-off signal, and immediately just plummeted. And that timing, that's what netted the trader that $192 million profit.
And that's the core of the controversy, isn't it? The timing. People in the crypto community immediately called it uncanny.
Uncanny is putting it mildly.
Right, which instantly led to this label, insider whale. In traditional finance, if a trade is timed that perfectly right before a major market-moving announcement, well, you don't usually think good luck.
No, you think someone knew something they shouldn't have. Privileged information, or at least some kind of predictive power way beyond the average person.
Exactly.
But, I understand the suspicion completely. But in a market like this, one that's unregulated, isn't there a danger of just calling any really successful big trade insider trading? Maybe it was just incredibly good forecasting. Where do the sources draw that line?
That's a really important point. And the line seems to be drawn at the sheer scale and the volume of this trade. It wasn't just a good prediction. It was so massive, it actually seemed to accelerate the market's downturn.
Okay. So it wasn't just riding the wave, it helped make the wave bigger.
Potentially, yes. And remember, this massive trade volume was public on Hyperliquid. We saw a commentary from an observer online, goes by MLM, who pointed out something interesting.
What's that?
Well, if this is the kind of huge trade the whale was willing to do out in the open on a decentralized exchange, imagine what else it might have been doing on CEX, centralized exchanges, or elsewhere, behind closed doors.
So this $192 million, however huge it sounds, might just be the visible part, the tip of the iceberg?
It's certainly possible. It could suggest a much larger, maybe coordinated market move.
Okay, so this is where the story takes another turn. The whale didn't just, cash out and disappear with the $192 million.
No, they doubled down.
Right. On Sunday, they opened another massive short position, a $163 million leveraged perpetual contract, again betting against Bitcoin, BTC.
Still bearish, using borrowed power to amplify that bet.
Borrowed power. That feels like the key concept here.
Right.
Leverage. We really need to break that down simply because it seems like it's the engine driving everything, the big wins and the big risks.
Absolutely crucial. Okay, let's use that analogy we talked about. Think of leverage like this. Imagine you go to bet on a horse race. You've only got $10 in your pocket.
Okay, not much.
But the betting window, the house, lends you another $90. So now you can place a $100 bet instead of just a $10 one. You're making a wager that's way bigger than the cash you actually put up yourself.
So you control a $100 position with only $10 of your own money.
Exactly. That's 10x leverage, which is what this whale was using on that second big trade. If they're right and Bitcoin's price drops, their profits get multiplied by 10, huge gains, really fast.
But the flip side.
The flip side is just as powerful. If the market moves against them, even by a little bit, their losses are also multiplied by 10. This is why these perpetual contracts on derivatives exchanges can be so incredibly risky.
And it's not just a vague risk, right?
Yeah.
The sources gave a specific number. For this new $163 million bet, if Bitcoin hits $125,500, boom.
Liquidation, yeah.
Explain liquidation. It sounds brutal.
It is brutal.
Yeah.
Liquidation means the exchange's system automatically closes your position. It seizes the collateral you put up, that initial $10 in our analogy, or whatever the whale put up, to instantly pay back the borrowed funds.
So you lose everything you put in. Instantly.
Everything. It's a complete wipeout of your initial investment. Catastrophic, like you said.
Wow.
And that risk, it doesn't just affect the whale. When someone this big makes these enormous leverage bets, it can set off a chain reaction across the whole market.
How so?
Well, the theory is that the whale's first huge short trade, the one that made the $192 million, actually caused something called a massive leverage flush.
A leverage flush.
Yeah. Their big move created so much sudden volatility that it started triggering liquidations for lots of other smaller traders who were also using leverage but maybe weren't as well capitalized.
Okay, so the whale's move knocks over the first domino, and then everyone else starts falling.
That's the idea. Their action essentially forces other leveraged positions to close, adding to the downward pressure.
We need that metaphor now. If the market is the ocean.
Right. Think of the whale's massive trade as a kind of giant financial tsunami hitting that ocean.
Okay.
All the smaller boats out there, those are the individual traders, especially those using high leverage. They just get swamped. They capsize instantly.
They get liquidated.
Exactly. They lose everything, not necessarily because their own prediction was wrong long term, but because the sudden extreme volatility triggered by the whale's move forced their positions to close automatically.
And we actually have numbers on the damage, right? Hypertracker data showed.
Yeah, it showed that over 250 wallets, traceable addresses on Hyperliquid, lost their millionaire status just since that Friday crash.
250 millionaires wiped out, essentially, on that one platform.
It represents a huge transfer of wealth from potentially smaller leverage traders to, well, entities like the whale.
And it's interesting to contrast that. You mentioned a source noting one trader who went the other way.
Yeah, a much smaller fish, relatively speaking. Someone opened an $11 million long position. Betting prices would go up using 40x leverage. Extremely risky the other way.
But clearly dwarfed by the bearish pressure. The shorts won this round.
Yeah.
Overwhelmingly.
Definitely seems that way.
So if we pull back and look at the bigger picture, this whole event, it really throws a harsh light on market integrity, doesn't it? Fairness, even.
Absolutely. This wasn't just, a bad day for some traders. It feels like a structural issue. We saw commentary from Janis Kluge, a researcher at SWP Berlin.
Right. What did Kluge say?
His take was pretty blunt. He said events like this show the reality of unregulated markets. His words were, insider trading, corruption, crime, and zero accountability. Strong stuff.
Zero accountability. And that criticism landed squarely on one of the biggest players, right? Binance.
Yes. After all this chaos, especially the liquidations, there was a lot of noise, a lot of speculation from traders pointing fingers at Binance.
What were they accusing Binance of?
Well, reports surfaced of order books on Binance failing during the volatility, critical stop-loss orders not executing when they should have.
Which would be disastrous if you're trying to limit your losses.
Exactly. Mass liquidations happening, and also reports that several specific tokens used as collateral, things like USDE, BNSOL, WBETH, apparently depegged from their expected value. which would cause even more liquidations.
So to many users, it looked like the system itself, on one of the world's biggest exchanges, was actually failing under pressure, amplifying the whole meltdown.
That was the accusation, yeah. It looked like a full system failure to many involved.
Okay, but what was Binance's official response? They must have said something.
They did, and this is where it gets really interesting. Binance officially denied any kind of crash or system failure. They basically said the reports were just a display issue.
A display issue. Like the numbers look wrong on the screen, but everything behind the scenes was fine?
That was the claim. They specifically stated their core futures and spot matching engines. The heart of the exchange remained operational throughout the whole event. They tried to reassure everyone that the fundamental tech worked.
But wait, how does that square with what happened next? Because didn't they end up paying people back?
Exactly. That's the major contradiction here.
Yeah.
If it was just a display issue, why would you need to pay out massive compensation?
Right.
Despite denying any system failure caused the crash, Binance offered around $283 million in compensation.
$283 million.
Yes, specifically to traders who got liquidated while holding those specific assets, USDE, BNSOL, WB, ETH as collateral. The very assets people said had depegged.
So they denied the house burned down, but they still paid for the water damage.
That's a good way to put it. The need to pay out hundreds of millions directly undermines the claim it was just a visual glitch. It makes no sense logically.
So what does that suggest?
It suggests the event was probably serious enough to really damage user trust or maybe attract unwanted regulatory attention, forcing them to make this huge payout to smooth things over. It fits right back into that zero accountability idea Kluge mentioned.
Fix the immediate problem with money rather than admit a deeper systemic issue.
Precisely. It's kind of a key insight into how these huge, often globally unregulated markets can operate. Problems happen, systems might fail, but the resolution is often financial, not necessarily transparent.
It's fascinating, though, that despite all this turmoil, the accusations, the massive payout, Binance's own token, BNB, actually did pretty well afterwards.
Yeah, remarkably resilient. It recovered strongly from the crash. Sources said it surged 14% to get back above $1,300.
So the market, at least, still seems to believe in Binance long-term, even with these kinds of operational questions during extreme stress.
The market has a short memory sometimes, or maybe it just accepts this as part of the game in crypto. It's hard to say for sure.
Okay, so let's try to tie this all together. What are the main takeaways here?
Well, I think this whole episode is just a really dramatic, real-world illustration of the core tension in these markets. On one hand, you have this massive, perfectly timed $192 million profit.
Showing the huge opportunity that exists.
Exactly. But on the other hand, you have the simultaneous mass liquidation of, 250 smaller accounts just on Hyperliquid, plus this $283 million compensation paradox from Binance.
Which highlights the really severe structural risks and, big questions about fairness.
Right. This combination of almost unbelievable timing, widespread losses for smaller players, and a major exchange acting in a contradictory way, it should really be flashing red lights for anyone trading with high leverage in these decentralized or maybe pseudo-decentralized spaces.
So thinking about the listener, what does this all really mean for you? When you see this mix, the near-perfect timing, the mass liquidations, a huge exchange paying out millions while denying anything was truly wrong, how should we even define unregulated when a market gets this big, this complex?
That's the question, isn't it?
Does just seeing the trade volume publicly, like on Hyperliquid, really mean there's accountability? Especially if the underlying system seems at times almost designed to shift wealth from the many to a few very large, very well-timed players. It's definitely something provocative to think about as you digest this deep dive.
A lot to mull over.
Indeed. Before we go, remember to follow, like, and share this deep dive, and you can also follow What Bitcoin Taught Me on Twitter X, Nostr, Blue Sky, Threads, Instagram, Facebook, and LinkedIn.